Anyway, it is 1 o'clock now, so I think we'll get started. Anyone that joins us late can watch with the video. So thank you very much, everyone, for joining us on what is quite a gloomy day here in Melbourne. We'll get started. We want to go through mastering the international dealing schedule for 2025. There's just been a few minor changes and extensions on that. And our focus, obviously, as transfer pricing specialists, will be around the transfer pricing aspects of the international dealing schedule. So what I want to go through today, moving on to the agenda, we'll go through what is the international dealing schedule. I think it's important to always understand the why for everything. Who needs to complete the international dealing schedule? What does the ATO actually do with the information, or what do they want to achieve? And then some of our, what we call our tips and tricks to make sure that you get it right as well. So moving on, I did jump from the agenda and just moved straight on to not introducing. Sorry about that, HC. So for many of you, I think I probably know at least half of you on today. My name's Shannon Smith. I'm the founding director of Transfer Pricing Solutions. I was with the Big Four for many years here in Australia, in Europe, Czech Republic and Amsterdam, then on to New York City before coming back here. I set up Transfer Pricing Solutions now. It would be about 18 years ago, and Transfer Pricing Solutions now has offices in Singapore and also in Malaysia as well. HC, I'm being joined by HC. HC's been with Transfer Pricing Solutions now over 7 years. I know that because I'm having to accrue for long service leave now on our books. And HC's based here in Australia, but actually has the fortunate position of being able to spend quite a bit of time also in Malaysia with our Malaysian team as well. So HC's been working in transfer pricing for over 12 years now in the transfer pricing space. So spends a lot of time here managing our team. We've got a team of I think we're over 10 now in Malaysia as well. So you get to live the best of both worlds. When we have bad weather like this is where you should be in Malaysia.
I should go back to Malaysia.
You shouldn't be in Australia at the moment. Sorry, jumping back into the agenda. Now I'll get going on what is the international dealings schedule. So just to give you a bit of history also around the international dealing schedule for those that may not be as familiar with it. Years ago, it was called the Schedule 25A. For those on the webinar today who are old enough to remember the days of the Schedule 25A, it then changed to the International Dealing Schedule, and transfer pricing is primarily the Section A of the International Dealing Schedule. Over time, the ATO has used this International Dealing Schedule as a means of gathering further information. As you've seen the ATO over the last number of years, as with many tax authorities around the world, there's been an increased focus on international transactions and cross-border situations as well. So the transfer pricing section of the International Dealing Schedule is primarily in Section A. However, we are actually seeing transfer pricing kind of filtering into many other areas, and more so recently in the thin cap areas as well. So Section A is the international related party dealings. That's what we're going to focus a lot of today on. Section B is around what we call, it's kind of the financial arrangement. So we call it the TOFA, which is not something that we deal with on a transfer pricing side. Section C is the CFCs. Section D is thin capitalization, which used to be something that I, as a transfer pricing advisor, was not as closely involved in. And over the last number of years, it really has become a lot more of a focus with transfer pricing. There's the financial services entities, probably not relevant to a lot of companies, miscellaneous. And then the other one that we've seen transfer pricing creeping quite a bit into is on the hybrid mismatches in G. And then in the last one, we have a new part of the schedule for this year, part H, which is the debt deduction. So that is also going to, over time, and we'll probably run a separate session on that. On the hybrid mismatches, we do have a separate webinar that we ran on that. We will probably look to rerun that again shortly as well. So the international dealing schedule is really used as a risk assessment tool for the ATO. You may prepare transfer pricing documentation, but until you're actually requested to provide that, the ATO does not have any information on your transfer pricing. So the international dealing schedule is giving them that information. It gives a snapshot of the company's transfer pricing position on a transaction base. Now, if I go back to the Schedule 25A days, it was quite a summary version of the international dealing schedule. There is now a lot more information. If I use services as an example, you're now describing all of the different services, how much level of documentation do we have, and which countries. So there's a lot more than what used to be included. If the international dealing schedule is filled in correctly, it will potentially trigger a transfer pricing risk review or potential audit. So it's really important to get it right, because this is the only information and does feed into the risk engine of the ATO. And so the Section A's I was talking about really captures the international related party dealings or transactions. And it should, one thing I like to really make sure of when you are looking at your international dealing schedule is making sure that schedule matches the documentation that you're then preparing to be able to support it. So we always encourage taxpayers to be preparing the IDS at the same time as preparing your documentation so that you're all saying the same thing. So who needs to complete the international dealing schedule? So pretty much all companies, trusts, partnerships. A lot of people don't realize that it does actually apply to the trusts and partnerships. It's not just about companies. If your international related party transactions are greater than $2 million in aggregate, so you can't net things off and balance it out like that. And it's talking about actual revenue and capital nature. So you've got your cross-border transactions, and then you've also got your loan balances added onto the top of that. So I do still see, especially on the smaller end of town, where you might have transactions under the 2 million and not realize that you've also got your loans as well. Now that's obviously the Section A of the international dealing schedule. What's going to trigger in the follow-on sections is going to be if you've got an interest in a foreign branch, subsidiary or trust. And then in addition to that, we've got the thin capitalization, if those provisions apply to you, if you may have any hub arrangements, offshore banking units, and then the hybrid mismatch. That is one that if you're not familiar with the hybrid mismatch, I suggest watching our webinar. We do have the recording on our website, because I think there's a lot of people that are by default just clicking no on that. And I do believe it does capture quite a few companies when you're going through. So what does the ATO hope to actually achieve with the international dealing schedule? And the reason I like to focus on this, if I can understand the why, what am I actually trying to achieve with any of the work that we're preparing, the documentation, how do I believe that the ATO and other tax authorities are going to look at it? That'll give me a good guide as to making sure that we're getting the information that's relevant. So why did the ATO, in a sense, develop the international dealing schedule? There are a number of countries around the world that are slowly incorporating transfer pricing aspects of their tax return as well. It's very common in the US. There is the transfer pricing section of the tax return as well, or the international transactions. Interestingly, China copied the Schedule 25A just as we were bringing in the international dealing schedule, so their section. So it is becoming a bit more common, but it is more just to get more specific disclosures. We're seeing that international dealing schedule being added to, as we see a new section this year, and it's really to gain greater visibility on the transfer pricing documentation that the groups have. So not only what are your transactions, what countries are you dealing in, specified countries, and what level of documentation that you've actually got. So it's really, and that's being linked, I guess, with also the CBC and the AUSTRAC data. So they're really trying to track the different financial movements around it as well. And it's really just to do from a risk engine perspective and potential audit activity. So what does the ATO do with all of that information? They do analyse the taxpayer information and the disclosures. It comes through on the risk engine. It may actually be that there are certain transactions that the ATO is focusing on if you have major changes from one year to another, or it can also be industry, and we've seen more and more on the industry as well, where they may target a particular industry and be looking at your financial outcomes in the international dealing schedule versus maybe others. So we have started to see a bit more on an industry level as well. But it's really coming down to the level of looking at the amount of documentation that you may actually have in place, so that the ATO can really identify what they can see as risky taxpayers, and then selecting those for potential risk reviews, asking the questions. I always call that the please explain, and then whether they want to proceed further on that. So really trying to look at a high level that information, and there is a lot of risk engine data benchmarking that they can do on the tax office side, and we're seeing a lot of this also more so too with the country by country reporting as well, that there is data being shared across the world between the different tax authorities, and some of the questions that we're seeing coming out and the data that is being shared across, especially between major countries such as Australia and the UK. There's a lot of data sharing that we're seeing between those two countries. So if we look at the international dealing schedule and the risk reviews, if you look at the international dealing schedule being the first point of call that the ATO has with the information on your transfer pricing. So often if they have selected that they want to review in more detail, you'll get what I often call the please explain letter. Please provide us your transfer pricing documentation. Please answer these particular questions that we have based on reviewing the international dealing schedule. And as I touched on earlier, when I like to prepare the documentation, I want to do that ideally at the same time as the international dealing schedule, so that we can be in a position to make sure what's being lodged to the ATO matches from a numbers perspective with what you're preparing the documentation, and that you're not requiring any adjustments. So we'll often get the questionnaire. Usually in reading the questionnaire that the ATO may send out, we usually have a pretty good idea as to what we believe may be their areas of concerns. It doesn't always mean that there is, something incorrect at that point. It just can be that maybe they want to understand a bit more. You may actually have in your documentation a perfectly good commercial reason why the outcomes were at what they were. We do find whenever our clients get a risk review, we want to get that in and out as quick as possible for our clients, because if something's to go to audit, it can be really costly, both on not only costs in potentially fees, but also in the time and the resources that it takes for the clients as well. And there's a lot more going on from a legal perspective around transfer pricing as well. And having the documentation in place can really assist in reducing penalties as well. So it's important when you're looking at the international dealing schedule, making sure that if you are looking at that with the documentation, that you can see there's the alignment, and trying to have that also prepared at the same time as well. So what are we going to do to try and make sure that we're not being unexpectedly selected? I'm going to hand you over to HC to go through some of our tips and tricks with some of the key sections of the international dealing schedule and where we see challenges that potentially have come up.
Thank you, Shannon. I think that paints a good picture of how we look at the IDS. So for this session, we're not going to go in detail for every questions. Rather, we'll be focusing on any questions that require further attention, or generally what we normally face with our clients. And before we go through the questions, I think it's good to emphasize what Shannon has mentioned earlier, whereby before completing the IDS, we would have analysis being performed, such as your transfer pricing documentation. You really need to have your TP documentation in place to be able to complete the IDS, because the IDS is more of a disclosure document rather than a analysis document. So anything that you disclose to the ATO, you need to make sure that is accurately completed, right? So when you have the TP documentation in place, actually then filling up the questions will be much easier. All right, first up, we'll be looking at question 1. So 1A is when your CBC reporting applies to you. We have a lot of questions in relation to this, because a lot of the times we have a lot of Australians are foreign controlled, and they will require further assessment to see whether they are indeed an SGE, significant global entity, that CBC reporting applies to you. So when CBC reporting applies to you, there is a administrative solutions that is available for taxpayers where you can prepare Part A. So local file has Part A, Part B in short form. So Part A is essentially the detailed IDS in the local file. So if you are able to then prepare and lodge at the same time of the income tax return, then you do not need to prepare question 2 to 18 and then skip to section B, right? All right, so question 2, which is the 2 million aggregate. So for this 2 million, we need to emphasize that it includes loan balances, right? So not just international derivative dealings, but the loan balance itself, right? Not the interest expense or revenue. So, and for IDS to be able to start, actually, if you look at the income tax return, question 16 to 28, if you tick yes for each question, it will lead you to IDS. So it includes CFC, this 2 million threshold, as well as any of the team cap questions, right? So if they apply to you, you have to prepare IDS. Now 2B, right, it relates to whether you're a small business, not SGE, whether your international reply dealings do not exceed 5 million and 50% of the turnover. The keyword here is N. So you need to fulfill all these criteria to be able to be exempted to prepare section A of the IDS, right? Only section A, so you still need to prepare the section B and so forth. And then next question is 3 and 4. So question 3 and 4 are more summarized questions, whereby the ATU wanted to know what are the top 3 countries that you transact with. And question 3 is more for non-specified, question 4 is specified. So it's always good to then relook every year on the appendices to make sure that the ATO does not include any of the new countries into the specific countries. It has happened before. So last time was, for example, Singapore was in there. They included Singapore, for example. So for question 3 and 4, generally we'll complete the other section first, 5 to 18, which are the breakdown of the international related party dealings. And then from there, you'll be able to then summarize it into question 3 and 4. Right, so you can start with 5 to 8, then come back to 3 and 4 to complete the summarized questions. Question 5, we have skipped question 5. Question 5 is trading stock, which is pretty straightforward. Question 6 relates to royalty versus license. Right, there's a very common misconception where a lot of taxpayers actually included, sales and purchase of software. Right, when you are in the business of selling software, it shouldn't be under royalty versus license. It should be under question 5, because that is your trading stock, right? So that should be in question 5. And question 6 relates to royalty and licenses in relation to the IP. So this question is really important in the sense that you will need to perform an assessment first to make sure whether that transaction or arrangement falls under royalty or license. The reason because is, if you have defined it as royalty, there may be withholding implications, while license do not have. So if you actually assess it wrongly, then there may be, withholding tax implication that may be imposed onto this royalty versus license. Question 6. Well, question 7 is actually rent and leasing. So you have any rent and leasing arrangements, then you should go to question 7. Question 8 is one of the more important questions that we need to focus on. So there are a lot of misconception between service arrangements and cost recharges, right? So a lot of the times when we look at the work papers, there are always cost recharges that are put inside service arrangements. You need to make sure that any transactions that we fill in question 8 relates to services rendered or services received. And when we term services, we are looking at activities actually rendered in relation to those categories. All right, not just cost recharging while the entity does not in substance provide that particular service. Generally speaking, this should be assessed in the transfer pricing documentation, but then you need to then relook at your TP documentation to make sure that when the TP documentation disclose it as management admin services, for example, you as a taxpayer or the tax agent you need to look at whether these are actual services being provided, or are these more of a cost recharges between entities, right, where no services or no activities are being performed. All right, so I'll just go through some of the more focused questions. Management and admin. So management and admin, it relates to management of staffing and assets, as well as your day-to-day admin services. On top of that, you need to look at, if you have employee-based plans, base management plans, any administrative services type to support the employee-based plan should be included here, while the actual plan payment should be in question 15, right? So there's a distinction between the two.
And that's an important one, because I think we've had a number of people contact us where they've had questions from the ATO, and those ones have been, I guess, allocated to the wrong section.
Yeah. So similar to insurance services, this section only includes the mention of insurance contracts, right? And should not include any premiums for insurance contracts, right? So for this section, it more or less will be generally between the undertaken with the intermediaries, while any premiums in relation to the insurance contracts will be under question 11, right, which I'll go through later. And then the next one, which has increased focus that we observe, because there's increased taxpayers that are enjoying the R&D tax incentive. So when we have R&D tax incentive, there are few layers that we need to make sure it's being done properly. First, when you have R&D tax incentive applications, the service provider will be looking at what are the services that are being defined as R&D, what are the costs that will be incurred, local plus foreign, that should be parked under the R&D tax incentive, right? So when you have that in place, and then your transfer pricing documentation will also reflect this assessment, then only you can then disclose what are the costs or revenue that is in relation to the R&D services. Any IT support, maintenance of software will be considered software and IT, right? Only those services that are in relation to research and development services should go into R&D, right? So these two should be separately disclosed, right? So if you guys have any other questions in relation to any of the service arrangements that you have queries about, feel free to go into Q&A, then we can manage the Q&A accordingly. Okay, question 9 will be derivatives. So we'll be looking at interest rate swaps, currency forwards, any financial dealings they'll be looking at will be in derivatives. So the definition of derivatives comes from the OECD. So if you have any issues or concerns with the definition of whether that arrangement falls under derivatives and falls under global trading, then it's advisable to actually go to the OECD definition to make sure that the arrangement falls within the derivatives arrangement, right? These questions is more so for ATU to assess whether the taxpayers is conducting derivative trading globally through a trading structure, so that they will be able to assess whether there are any profits being shared between the international related parties. Then question 10 is debt factoring and securitization. So debt factoring is more so selling like your accounts receivable at a discount to a factor, right? Be it a third party or your related party, right? Generally, ATU will be looking at this as though it's more or less a third party type arrangement, but it's there if there are any arrangements between related parties, so that we can disclose it in this question 10. Similar to securitization, whereby you're selling assets to a financial assets to a SPV, for example, right? Then this should also be disclosed under question 10. All right. So question 11, one of more focused question as well. So question 11 focus on financial dealings. A lot of your loans will be in here. So question A and B will be your interest-bearing and interest-free loans. So here, it's also a risk assessment for ATO, whereby the ATO has introduced an interest-free schedule for their PCGs. But at the end of the day, it's more so looking at whether your loan is a debt or equity, right? A loan generally in an arm's length position shouldn't be interest free, right? If it's interest free, you may need to actually relook at them and see whether, on a debt versus equity point of view, whether it falls more in line with an equity definition as opposed to a debt. So if you have an interest-free amount that is in the IDS, that's some of the things that ATO may look at and see whether interest should be imposed to these loans, right? So this is one of the sections that they can see.
And it was interesting that section 11 in updating the international dealing schedule, they actually have not made any changes to question 11. And I thought, in light of, obviously we've got the thin capitalization challenges and coming up now with the changes in legislation, I had expected that they may have added some additional fields in here. They haven't. So it will be interesting to see what they do with this information in gathering, obviously gathering the loan balances and the pricing methodologies. But I was actually surprised that they didn't put in a few more fields here to gather some extra information.
Yeah. I'm sure they will.
They probably ran out of time.
Yeah. They'll take care of the tin cap and the debt. I'm saying that amount first. Then go back to the IDS soon.
And then go back. Yeah.
Yeah. Another point to note is I still see the average balance being opening balance plus closing balance divided by 2. Just to re-emphasize, the average balance is actually opening balance, Q1 balance, Q2, Q3 balance, and then your closing balance, 5 different balances add up together and then divided by 5, right? So that's the correct average balance for your loans. All right. So 11C will be your interest section, interest expense, interest revenue. Then D will be guarantees. So if guarantees here relates to guarantee fees charged in relation to the financial dealings, doesn't need to be loan. So any guarantee fees that is in relation to financial dealings for any obligations to repay, then it will be here. And then 11E and F would be insurance and reinsurance, which I've explained earlier. So only premiums in relation to reinsurance will be here. And then any other financial dealings that are not in relation to these should be other financial dealings. So 11G will be another section that needs to be aware of, right? It relates to your forex gains and losses, right? So this should reflect your income tax return. So if you have any forex gains and losses in relation to the financial dealings of question 11, right? Not just question 11 alone, it also includes your any accounts receivable, payable with your related parties. Not in general, but with your related parties, as you imagine, international dealings is all about the related parties. Any forex losses or gains in relation to related parties should be then disclosed here. You can look at the respective codings in the appendices to look at what code that you need to choose that is in relation to the arrangement itself. It doesn't need to be a loan only, right? It can be the accounts receivable or payable. Okay. So, and to re-emphasize, so 11A and B, that relates to loan, right? So it's in relation to Div 704. So if it's in relation to accounts receivable and payable, it shouldn't be in 11A or B. Okay. Okay, next is question 12. Yeah. So Question 12 is if there are arrangements that doesn't fall under question 5 to 11. Okay, so one of the main transaction that we put in question 12 would be recharges. Okay, so recharges should go in question 12 with the correct description in the comment section to make sure that any recharges just in when the ATO would come into question, it should reflect both your TBD and the IDS, so both should be the same. And then 13 will be in a capital nature. So 12 will be revenue nature, 13 will be in capital nature. All right. Question 15. Yeah. So basically what Chair has talked about. So there are a lot of questions surrounding share-based remuneration. So it's a bit complex. So again, the disclosure really reflects your transfer pricing documentation. So which means you need to assess how are these valued, what are the approaches undertaken for this share-based remuneration in the transfer pricing documentation before you can actually disclose it in question 15. And then question 16 is cost contribution arrangements. So now it is it's a simple disclosure, but at the same time, again, this is also a risk assessment from ATO's point of view, right? So CCA is very different from service arrangements. So there are a lot of misconceptions between service arrangements and CCA. The key difference is CCA is more cost sharing arrangement, whereby services you should have a cost plus markup arrangement, whereby CCA doesn't have the markup in place. So when you have a CCA disclosure, you need to make sure that all the documentation are performed correctly, including any agreements in place for the CCA, to make sure that it's future proof and that the ATO would not link you back from a CCA to a service arrangement, right? So that's one of the risk area that we look at. All right, so question 17. Now, when we look back at the first disclosure, question 2A, where they ask you whether you're above 2 million AUD. So if you're below 2 million, then you have to skip to question 17 still. So you still have to disclose the restructuring and your branch operations. Now, business restructuring has developed quite a bit in the sense that the ATO is actually focusing really on the restructuring, and you have to make sure that, again, the reassessment on the restructuring needs to be performed to make sure that when you disclose any business restructuring events, it reflects the TBD again, because when there's a restructuring occurs, right, the ATO will be able to assess whether it has become a more risky, you have gone into a more risky position or not, right, depending on the business restructuring. Now, then question 18 is branch operations. In relation to branch operations, the main distinction between question 18 and the other section is that because of the way how branch operations work when you actually record the financials, because all the dealings are within one financial statement. These are internal dealings. So the internal dealings within the branch should be included question 18, right? Not the branch with another related entity. So if there's a branch arrangement with another related entities, it should still be under question 5 to 16. So here is only internal dealings that you disclose. All right, let me see. Okay. Shannon, you want to go through the other sections or?
Yeah, so touching on, just as I touched on a bit earlier, but the other sections of the international dealing schedule. So section A is when we're looking at the international related party dealings. Now section B, I touched on financial transactions and then obviously the CFCs. The thin capitalization, we're going to see more interaction with transfer pricing on that side. and the financial service entities. Miscellaneous, and then the hybrid mismatches, as I said before, we do have a separate section on the hybrid mismatches as well, separate webinar, and we'll probably refresh that, I guess. And then we'll be looking at this debt deductions creation rules as well. So just touching on each of these particular areas. Now, you wanting to go back onto those, HC? Is that? Yeah, back onto the notable sections. We're not going to go through all of the details on these, but we just wanted to raise some of the key highlight points on it. And where applicable, we will do some more detailed webinars on this in the future.
Yeah. So, as Shannon mentioned, generally we look at Section A, but there are a lot of sections that relates to transfer pricing that we would want further attention to. So if you look at Section C, it sort of reassess the CFC. But on top of that, when you complete Section C, it's not just when you say no to the first question, it disregard the whole Section C. No, you have to go through one by one. It goes question 21 to 24, then 24 to 27, and so forth. So you still need to complete certain questions in Section C. All right, so you just don't say no and then you disregard the Section C. So
even if your tax software comes up with validations all okay, you need to make sure you go through, because I think a lot of the tax software in the past, you push no and everything would go away. Or, if you haven't answered all the questions, you'll get a validation error. And I'm not seeing that happen as much. So if you're not as familiar with these sections, as HC is saying, make sure you actually go through and answer the relevant questions, because we don't see all the validation errors coming up, and therefore people are missing these sections.
Okay, I'll just jump our focus to question 28B, which is the 2017-1, the hard risk assessment. So when you have this type of arrangement, you need to then relook at to disclose whether you have any of the arrangement that falls under the schedule for PCG 2017-1. So for now, there are still 2 schedules. There are 4 schedules in place. Until now, it's still there are only 2 schedules, which are the offshore marketing hub arrangement, which is actually pretty important, because there is this recent case with BHP that actually falls under this marketing hub arrangement. Maybe that's one reason why it has happened introduced. Schedule 2 will be your non-core procurement hub arrangements. So this relates to your non-core business activities where you have procurement in place for non-core products. So if you have any of these arrangement in place, you will need to then reassess and then complete question 28B. Okay. Then now comes section D. So section D, TINCAP is a new section since 2024 income year. The 2 million threshold still applies. The 90% asset threshold test is still there. One thing I need to make note of is the 2 million threshold definition. It's not just the taxpayer, it's the taxpayer and associated entities. Now, even if you have no debt deduction, but if you and your associate entity has above 2 million threshold, then you still need to prepare this TINCAP. So there are a lot of constraints here whereby there are different Australian groups within the total Australian groups and there are different tax agents for each Australian group. Hence, I think the communication needs to be open between the tax agent to ensure that all the Australian groups are aligned, that if they have above 2 million, which tax agent is the one that will be looking at the TINCAP TINCAP rules, and then you then have to then disclose it into section D. Okay, so since 2024, the 3 new tests has been replaced. So it's your fixed ratio test, group ratio test, and third-party debt test. So the tax agent will really need to then relook at, if let's say you're above all this threshold and you need to do the calculation for TINCAP, these 3 tests will allow you to see which test will be best, most feasible for you to ensure that you don't get denied for your interest deduction, right? So your tax agent will need to prepare this test to make sure that they chose the correct test to use, right? So that's section D. Then section G is hybrid mismatch. As Shannon explained, is the make sure that you look at the relevant PCG. They have already updated into 2021/5 instead of a draft section. So hybrid mismatch is a bit it's more of a complex area whereby it's we will need to then look at not just the taxpayer's point of view. You need to information from your counterparty to make sure that if there is any hybrid mismatches in place, whether there will be any denial or not, right? So this assessment is very important to make sure that when you disclose section G, you have to disclose it accurately.
And I think now we're starting to see questions coming from the tax office on this more. I think in the first year or so of the lodgement, we didn't see that so much. So we're getting, I guess, more questions coming from taxpayers or tax agents in relation to the hybrid mismatch, where they're getting questions from the tax office where either the form hasn't been filled in and the tax office has information to believe it should have been, or they have filled in the section, but some of the answers to the questions may conflict with other parts of the return or something.
Yeah,
I think it's probably linked into the risk engine now, whereas maybe for the first year or two, they're just gathering data in relation to it.
It does, because when you look at, that's another thing about IDS. When you look at the IDS, the ATO will be able to assess whether hybrid mismatches may exist when they look at your countries. When you look at countries, for example, you have the US, where they have to check the box arrangement, there might be a hybrid mismatch in place. If you click no, and the ATO might think that there may be hybrid mismatches in place. So there's one of the risk assessment that they will look at to see whether there's any potential to actually go forward for a review or not. Okay, yeah, the new section in 2025 would be a section H, debt deduction creation rules. Well, it's sort of in line with the Treasury Law amendments, where they wanted to make sure that the DDCR is disclosed properly. Now, if you look at section H, there are a lot of questions in relation to both the TIN cap and your business restructuring. Okay, so if you have TIN cap, more or less section H you have to actually complete, right? So it's more of a combination of TIN cap disclosure and your business restructuring disclosure, as well as looking into if you fall under the CBCR, you can have there's a special transitional rule whereby under the short form for country by country reporting, there is a question in relation to business restructuring. So if you actually prepared the short form and you have actually filled in your business restructuring questions that relates to business restructuring, you can actually then use your short form disclosure as part of this section H. So it applies to both section H as well as the business restructuring question 18, right? So yeah, so when you have all this disclosure, then you'll be able to complete the DDCR section. All right. Key takeaways. Shannon.
Yeah.
You can start with your key takeaways.
I will. Yep. So the international dealing schedule, it's really important to know that this is often the first point of call that the ATO has on your international related party transaction. So it's really important to make sure that you get those in the right spot just to avoid some unnecessary confusion. But make sure it's important to note with the different parts of the international dealing schedule that it is based on accounting values. Now, That may seem strange because it's in a tax return. I guess when they did the Schedule 25A and it became the International Dealing Schedule, then for whatever reason, and there was a lot of dialogue back then on the International Dealing Schedule because there was an expectation that that would be based on tax values because the IDS is part of the tax return. But a number of the different questions are actually based on accounting values, and that actually is described in the instructions. So it is important to note what values you're actually using at that point. We need to ensure there's consistency between the TP documentation and the International Dealing Schedule. That's really important because that's going to be, I always say, I was an ex-auditor, so starting my career, as many of us do in audit at the Big Four. I always want to make sure that if that's what I'm lodging to the tax office, I want them to come in and out as quick as possible with my clients. And if that means they have everything as per the tax return, I want that to be mirroring the values that I've got in the transfer pricing documentation, and then the support is in the documentation. So I want them to be able to tick through their checklist from a tax authority perspective and get in and out as possible, as quick as possible. Really important to look at the Appendix 5, the arm's length pricing methods. We see a lot of errors around the arm's length pricing methods selected. One looking at cost plus versus TNMM. I teach at Melbourne Law School, and I'm always talking a lot about the methods there and making sure that people, when I might ask a client, how are you pricing your transaction? They'll often say, oh, it's on a cost plus. And I'll be like, is that a cost plus at a gross margin level, or is that at a cost plus at a net margin level? Because if it's a cost plus at a net margin level, then we're talking TNMM. So really making sure that you get that correct, because again, that's going to be something that feeds into the risk engine as well. Appendix 9, percentage of documentation. Now, I always think this is like the booby trap question. This is like the trick question. Because if you actually say the percentage of documentation that you have is less than 50%, then you're actually telling the tax office we don't have a reasonably arguable position. So I feel like this is I'm trying to set you up question that if you answer this, we're going to potentially look at it as well. And then making sure, we do see a number of times when someone might get a review, and often they might contact us when the tax office has reached out, and then we'll review their international dealing schedule that's been lodged. There might be either a net off or the revenue and expenses might be netted off. Even sometimes we see it in the wrong spots on it as well. So they're probably the key things that we see that can sometimes unnecessarily trigger a review as well. If you do need further help, so how transfer pricing solutions can help you, we can review or prepare your international dealing schedule. We can assist you with transfer pricing documentation, and where you're required, we can assist with the PCG analysis for the various different PCGs that are now available that are really kind of giving you an insight as to what the tax office is going to be looking at, and to kind of give you an idea of where your position is going to be. Often when we go through documentation or even on the PCG analysis, we will even, if we do see any areas of concern, we'll put together kind of a management letter, which will be not part of your documentation, but something for management to be aware of where we see there may be potential risks or concerns, even if we have prepared the documentation, just so that that gives management an ability to make a decision if they want to change anything at all. So I'll open it up to questions now. Where have we got here? There's software available on the Prepare the Local file. We've got also our country by country reporting. We do have our webinar recording on that as well. Okay. Now, if the international related party dealings are less than 2 million, do the questions under 15 to 16? Or is that gone? Did you just move that one?
I moved the software one, which I think there are a few software providers that prepare the local file. Yeah.
Yeah.
And we do assist with preparation of local file.
Yeah. Yeah.
So the other one is, if the RPD is less than 2 million, does any of the questions under 5 to 16 need to be answered? The answer is no. So if you have, including the loan balances, if you have no under that section, then you can skip question 5 to 16. Then you have to answer 17. for the restructuring.
Yeah. But make sure that you've gone through what those transactions are that you've actually got. I find it really important to make sure you gather all those transactions, don't net them off, because we do see that is an issue, and then make sure you've got the loans in there as well.
Yeah, correct.
The next one, we've got quite a lengthy, if that person wants to reach out, they've got a scenario. I think that's probably very specific to their situation. If you just want to reach out, that's probably something we can chat with lots of different company options on it.
Yeah.
If the debt deduction is less than 2 million and the taxpayer relies on the simplified record keeping method, is the taxpayer required to conduct a transfer pricing analysis? One thing that's really important with this is with the simplified transfer pricing record keeping options, there is criteria that needs to be satisfied. And part of that is also that you have documented your situation around that. Does it mean that you need to do full documentation? No, you don't need to do full documentation. That's, I guess, part of the aspect of the simplified, but you need to document that you satisfy the criteria and make sure you can actually support that part of it as well. So it's not just a by default, you do need to still do that. We try and encourage clients where possible to, if they are happy with the rates that are in the simplified options when it comes to debt pricing, it is quite a good option because the cost of actually the debt pricing analysis, the benchmarking is quite costly. So, but not all, it depends if you're actually happy with the rates that are actually available.
Yeah. 2025-D2.
Yes, we actually have started to look into this compliance approach. So that is in draft at the moment. The feedback was supposed to go in by 30th of June. They've extended that now, I think, another week as well. And I guess we had a few comments on that one as well. So we will have, we will probably another month or so wait till the final come. It was probably 2 months for the final to come out after that.
Yeah, and we have actually spoken to ATO as well in relation to this. So we have actually exchanged emails in relation to the PCG.
Yeah, yeah. What are the cost charges disclosed in the IDS? When you're looking at it, cost recharges could actually be, when you go back to the first definition, is there an international related party transaction? As soon as there is it's international, it's related party, and it's a transaction or dealing, it should be disclosed. So in actually question 12, I would err on the side of caution, saying I would be including any cross-border transactions and using the box there to describe what those are. But if it's an international related party and it's a cross-border transaction, it should be disclosed. But often the recharge might be just literally direct recharges. We will put and use that box as much as possible, the definitions to actually describe what those recharges are.
Yep.
If the client has obtained transfer pricing documentation for all the cross-party dealings, then would it be okay to disclose 100% documentation? In theory, you could. We always actually do 5. No one's game forever and a day, even when it was the Schedule 25A, no one was game to actually say we have 100%. So I don't think I've ever seen a situation where someone has written 6, which means 100%. Rule of thumb, we've always disclosed 5 to say that that you've actually not at 100%. But if they've got the documentation, one thing about the documentation is making sure. So if you have a client, I don't know if that's an accountant or a taxpayer, but even if you're a taxpayer and your head office says we've actually prepared the documentation for you, so you don't need to worry about it in Australia, we've already prepared it for you. You need to make sure you get a copy of it. You need to make sure that it actually addresses the Australian transfer pricing legislation. And that's what we often find it doesn't when it has been prepared internationally. It doesn't mean that you're going to have to prepare a full brand new documentation. Depending on the size of the entity, sometimes it may be that you actually prepare an addendum to that documentation to ensure that you've actually complied with the Australian legislation. But I would always be encouraging you to get a copy of that and make sure that it has covered all of your transactions. So the question 6, invoices issued should be disclosed based on that. I usually do it at the invoice date, and I use the ATO, either the rate that it's come in. So this is about if it's issued in foreign currency, either the rate that it's come in at that time when the payment's been made, or I use the ATO Forex rates.
Yeah, and this one, it should reflect your income tax return. Whatever you disclose in the income tax return, it should then reflect whatever you disclosed. So, yeah.
In the case of a loan received by a company from a related party where no interest is charged and no agreement has been executed, would it be appropriate to disclose 0 in interest under 11A of the IDS and report 0 in the transfer pricing disclosure? I'm assuming that means documentation. Yet you wouldn't have any documentation. Obviously, if it's a inbound loan, so that means a loan from a parent company coming into Australia and there's been no interest charged, the ATO is not that concerned about it. They don't, they've got free money here to be used, and the foreign parent company, the country may have a problem with it. But if it is actually the reverse way, you'd have to go through the process as to why is the loan having no interest on that at all.
Yeah, then it should be disclosed under the interest-free section instead of the interest-bearing section.
Yeah. Do we have any other questions? If anyone's got any other questions? No? Okay, so we do have, we will have this recording from today will be on our YouTube channel. If you flick through to our YouTube channel, you'll see we've got all of our other prior recordings as well. We've got some transfer pricing 101. We've got specialist areas on the different transfer pricing as well. Webinar upcoming. We actually have tariffs and transfer pricing, safeguarding multinational enterprises' supply chains on the 13th of August. Let's see what Trump does with all of his tariffs and everything that's going on, because I think that is going to have, it's been interesting chatting with clients as to how they're going to, how are they going to deal with that? Who's going to, what it's going to have an impact on transfer pricing and tax authority. We've been chatting with the tax office on that one as well as to what are we going to do on that side. Feel free to reach out if you have any questions or if we can assist you at all. Obviously, we're based in Australia, Singapore and Malaysia, and we're happy to help you around the globe. Thanks very much for joining, and we will send through the CPD certificates as well. Thank you.
Oh, thanks. Thanks, Shan.
Bye.
Yeah, bye.